Okay, we're going to hit on some common mistakes that have come up over the years or individuals have expressed to us with cash value life insurance products, whole life insurance, and really why they have buyer's remorse or what they want to watch out for. So we're going to touch on several different items here. And what I'll mention as we go through the items that usually result in mistakes occurring is it always is a result usually of lack of understanding the insurance product, the insurance company, whatever it might be, and or lack of transparency. We didn't have all of the information, all of the data up front, or we didn't understand it. It kind of got brushed over by the agent we were working with. And then we have buyer's remorse down the road because I find out it could have been set up differently. So let's go through a couple items here. The first one we have is dividends and interest. So what this means with a life insurance policy, if I see a dividend rate with any cash value life insurance product, that typically means what? If I'm earning a 6% dividend, do I earn 6% on my entire cash value? Meaning if I have 100 grand in cash value, should it grow by $6,000 that year? Well, if I see a 6% dividend rate, that common sense would tell me yes. However, with a cash value life insurance policy, that is not the case. What's important to be aware of here is anytime I see a dividend or even a guaranteed rate of 4%, whatever it might be, keep this in mind. That is a gross rate credited after the insurance company's insurance expenses and mortality charges. Typically, you'll find when you run the actual numbers on a cash value life insurance policy, is if I have a dividend rate of 6%, once I'm in the policy for a couple of years, my actual annual IRR, internal rate of return, might be 4%. Typically, I can expect the net yields to fall anywhere from 1 to 2% below the credited dividend rate. So key point, remember it is a gross rate that the insurance company credits. I want to look at the net returns at the end of the day. So next, loan interest. This is a good one. So whenever I have a loan interest rate on a life insurance policy, the big question or the big thing that comes up often is, where does it go? Because there's a lot of material out there that makes it sound like, hey, pay the interest to yourself. If we're looking at cash flow banking, banking yourself, whatever it might be. The thing is, if I have an interest rate on a policy, if my policy has a loan interest rate of 5% and I borrow against that policy, that 5% loan interest expense goes to the insurance company. Yeah, I can charge myself extra interest, which is really just paying more money into PUAs. Good to be aware of that, but the loan interest rate goes to the insurance company. And then I also want to look at the insurance policy. Does it have a fixed rate or does it have a variable rate? How often can that variable rate adjust? Typically, it's only one time per year, and there's a cap on it as well. Depends on the specific insurance company and product though. Let's continue on. Flexibility. This one's my favorite. And the reason why is when we think of an insurance product, a lot of times people are under the impression that they have to pay the same premium every month, every year, and it's kind of boring. They get into the product thinking, all right, I've got to pay it and that's it. And if I want to add more money, I have to take out a new policy, right? And a lot of agents say, yeah, definitely, because that's where it's profitable for them. The thing is, and this does have to do with the policy design, which we'll touch on in a minute here, but you can design a policy to be extremely flexible. What that means is I can set it up where I can commit to a minimum premium and I can add more at leisure. Or if I come into a windfall, if I get a bonus at work, if I clear some debt and now my cash flow is improved, I can add more money into an existing cash value life insurance policy. I don't have to start all over. And this helps me use the policy more as a flexible savings asset, not just a rigid insurance bill. So my payments can adjust up and down over time. Very attractive when I learn how to do that. Policy design, we touch on this quite a bit. So when it comes to the policy design, where can our money go? Insurance premium or the PUA rider? What's important here is to understand the limits with our life insurance policy. If I'm going to pay $1 in, how much of that dollar, from a percentage standpoint, can go towards the premium piece, and how much can go into the PUA rider piece. And whatever product and company and riders I have set up, how do I minimize the insurance premium and maximize the PUA component? What that is going to do every single time for me, especially when I look at the pure guaranteed values, is maximize my upfront cash value and long-term cash value. The guarantees will speak the truth to that every single time. So policy design is the key to maximizing upfront cash value, but then also long-term. Last piece, company selection. So you do not need me or anyone out there to tell you that there's a lot of insurance companies out there. We can turn on the news or the TV for 15 minutes and get a ton of advertisements. The thing is, when it comes to a cash value life insurance policy, there is a lot of material out there in respect to whole life that states whole life insurance is a horrible place to position money or a horrible investment, even though it should not be considered an investment. But the thing is, whenever we are looking at a life insurance policy, what I don't want, this is me personally, is to purchase a policy based off of the parameters of an illustration and it looks great, and then time passes and it really under-delivers. And then it matches all those articles I read online. Why'd I do it? I wish I would have done something else, yada, yada, yada. So when it comes to company selection, a lot of companies have this, some disclose it, some don't, is we want to look at the actual or historical performance, meaning anytime we go to purchase a policy, what do we get? Hey, if I pay in $10,000 or $50,000 per year, here's my cash value build up over time. Here's the guarantees, but then here's the current dividend scale. Based off of that current dividend scale, what will the values look like? Really great. Okay, let's buy it because I'm expecting that to happen. Now, dividends go down. My cash value doesn't match that illustration. The thing I want to look at is actual performance. Who not just has projected great cash values, but has actually delivered over time. We want to request some of that proof. This way, again, we don't have buyer's remorse where we were told or thought the policy was going to produce $1 million and end up with $400,000. No, we want to make sure that the company we are selecting has actually delivered over time. So we want to understand, or common mistakes is lack of transparency or understanding around how dividends and interest work, around how loan interest works. Flexibility is huge. We hear often, I didn't know I could add more to that existing policy, or if it was set up differently, I could have added more, but now I'm kind of stuck with it. I can't add more funds in there. Policy design, right? How do I minimize the premium piece and maximize the PUA component, which again is my cash value? And then company selection. Here's my big thing with all of this. Look at options. If I want to see a variety of different policies and the way that they are designed, look at different products with 1, 2, 3 companies. This way I can get all the information up front, understand the flexibility features, and not have buyer's remorse. Hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.